Okay, we have the last video of the last chapter. So in this video, we're going to actually cover a number of concepts, and they have to do with interest rates. And it can be confusing at times, so I want to make sure that we lay the groundwork for how this all works. So just to remind ourselves, in chapter 12, we are going over different ways to look at and evaluate capital expenditures. In other words, when we buy multi-year items, different from raw materials or any finished goods or anything like that, when we buy a factory or we buy equipment or we buy vehicles or something that lasts a long time, we have a lot of cash up front that we pay, and then we have to figure out whether or not that was a good investment. And it's not enough at the end of the investment to say and look back and say, oh yeah, we made enough money. We have to have different ways of being able to evaluate before we invest the money to see if we're going to get back as much money as we hope to, or at least that we were planning to. So to kind of bring us back to the first video, we said that this chapter was going to be over two broad categories of ways of looking at capital expenditures, capital investments. One was non-discounting ways, where we did not take into account interest rates or the impact of interest. And those were payback period and the accounting rate of return. And we covered those previously. Now we're getting to get into the discounting. And we'll tackle the word discount in just a moment. But essentially it means those items that have to do with involving the time value of money or interest. And we're going to primarily going to work with net present value. And we will also touch on two kind of more minor ways of looking at it, which is the internal rate of return and the profitability index. But primarily, we're going to do a bunch of work on net present value. Well, just the word net present value brings up the idea of these four categories. So you'll notice if you've already started the homework or started the reading, you're going to quickly get into a couple of, specifically four big tables. And they'll say present value of a dollar is, a dollar, present value of annuity of a dollar, future value of annuity. So all these mean is whatever the word is, present value or future value, let's take these as two categories. This is the question, right? If they say, you're going to inherit $1 million in 10 years. And you want to know, well, what's the amount of money today? Well, that's the present value. That's the question. What is today's value? You've been given the future value. What's today's value? So you would use the present value table. If you have, you're given $1 million today and you invest it, what will the future value be? In other words, whatever the name of the table is, that's the question. What is the future value? What is the present value? The difference between annuity and just the regular one for both of these is present value of annuity is if you put in the same amount of money each year. And future value of annuity is, once again, what I guess the better way to say it, annuity means the same amount of money happens every year. In other words, if you're trying to say, if I put in, for example, future value of annuity, if I put $20,000 towards my kids' college education every year for 10 years, how much money would I have? Well, you'd have 20,000 times 10, but you'd have all of the interest that's building up too. Or you could just say, if I put in 100,000 right now and just let it collect interest, that would just be a future value. In other words, future value and present value are one-time lump sums. Annuities are multi-year, the same amount each year. And it's important that annuity, whichever one, has to be the same amount each year. If it's not, then you have to do a whole bunch of separate individual present value and future values. And we're actually going to have some questions that deal with this. So without trying to explain all the tables, I'm going to just give you kind of a really rough explanation of present value and future value. I'm going to go through, this first one here. So if you had, this is kind of a future value calculation. If I said you started off with $100 and you could invest it at 10%, how much would you have at the end of 4 years? Well, we can actually do that calculation. Well, the reason why I chose 10% is because 10% is easy to do on any number. It's just moving 10% of this number is just moving the decimal place one space. That's what it's 1/10, right? 10%. So you just move the decimal place. So here, 1/10 of $100 is $10. So 10% of 100 is 10. Well, you have the $100, you gain $10 of interest. So at the end of the year, you have $110. Well, we take that and we start over and we say on year 2, I start off with $110. I get 10% of that. Well, that's $11, right? Equals $11. And then I add that to the original 110 at the beginning of the year, and I have 121. I do that every year, right? I take whatever the accumulated amount plus its interest and then multiply that by 10%. So 10% of 121 is $12.10, plus the 121 is $133.10, etc., etc. So we have these four numbers where I could say, okay, I can actually hand calculate how much I would have at the end of 4 years if I initially invested $100 at 10% for 4 years. Those are the numbers I need to know. What's the amount, what's the percentage rate, and what's the period? And I could say, well, it's $146.41. Well, wouldn't it be nice if I had, well, of course you can do it on financial calculators, but how we originally did it was through tables. So let's go through the future value table. Oop, that got pushed down. The future value table. So this is the same numbers that I just went through. 110, 121, 133.1, 146.41. Here's the future value of $1. Now, obviously, the table is much bigger. It's got everything from 1% up to 20%. It's got periods 1 through 5, plus all the way up to periods 20 or 50 or 100. But I'm just taking a small section that's covering the place that we're looking at. So our percentage is 10%, and we're looking at the first 4 years, right? So if you notice, this is a future value of $1. And the reason why the tables are all of $1 is because it's a factor. In other words, if they calculate it at $1, you can take whatever number you have and just multiply it by the factor. So if your number is 100, well, you just take whatever this number is and multiply it by 100. If your number is 3,205, you just take this number and multiply it by 3,205. In other words, it's a factor. You don't have to have, they don't have the tables for all the different numbers. It's just one, and you multiply your dollar amount by this. Now, if you notice here, if we multiplied 1.1 times 100, that would be $110, which is what we hand calculated. For year 2, 121, which is what we calculated, 133 and 10 cents, which is what we calculated. And in fact, we calculated one extra decimal place that they didn't have. So if I was to ask you, without hand calculating, without having to do the plus times 10% plus the original amount, if I said, what was the amount if I invested $100 at 10%, at 10% for 5 years? Well, you would go down the chart, 10% down to year 5, multiply that by 100. It'd be $161.10. And we could hand calculate it too. Now, we can also go the other way. We can go, what is the present value? So let me say let me give a situation where I say, I know there's an amount of money that I need in 5 years. I need to have $161.10 in 5 years. And I know my investment rate is 10%. How much do I need to invest now to get to this? Well, obviously we can see that by this chart, okay, it'd be $161.10. I mean, it would be $100 over 5 years would give you $161. So start off with $100. So that a lot of questions are, I need X, I need to retire. I need to have $1 million in the bank. What do I need to start investing now? Well, that's the present value. And how do we get the present value? Well, if I was to just look at this number and say, okay, how would I get back to $100? Well, when I just divide this by 146, in other words, going up, I multiplied it by plus times 10% and added it in, wouldn't I kind of reverse the process? Or if I just wanted to leap over these numbers, I could say, okay, if I divided by, I know the number is 1464. If I divided by that, I could get to it. Well, that's essentially what the present value table is. So if I take whatever the period is, if I take 1 over, and I've got it right here, 1.464. In other words, I could take some number and say, if I need a certain amount of money in 4 years, rather than be specific to $100 or 146, if I need some number, I would just take this 1 over this number, or 100 over this number. And that's what the present value table. If we go down to the present value table, here it is, 683. In other words, the present value table is just the inverse of the future value table. It's the same numbers. In other words, if I took 1 over 1.331, it would be this number. If I took 1 over 1.21, it would be this number. So these tables are linked in that they're doing the same thing. It's just one's going forward and then one's going backwards in time. So it's the same calculation. And I'm not going to go into detail about how to figure out the annuity, but it's the same thing with those as well. You can hand calculate them. Someone hand calculated them and put them in a table. They're not just made up and pulled out of nowhere, and they're not some fancy math, I guess is what I'm saying. They're just tables to make it easier to figure things out. And just remember, I've already mentioned it, annuity has to be the same amount each year. So the question is always going to be, when you get into these tables, of which one do I use? Do I use the present value? Do I use the future value? And do I use annuity of either one? Well, we're going to look at a couple of these and try and figure out, kind of get better at doing it. Just remember, if they give you some amount, you have X amount today, and they want to know what's in the future, kind of, even if they don't use the word future, if they say in 5 years, well, 5 years from now is the future. Or if they say you're going to get $100,000 in 5 years, how much is that worth today? Just try and figure out what is the unknown. Is the present value unknown, or is the future value unknown? And the second thing is, do they give you one lump sum, or do they give you the same amount of money over multiple years? And that will determine present value versus future value and whether it's an annuity or not. Okay, so similar to the last video, I've left, rather than writing in most of these numbers, I've left them kind of already in the document, just because I don't want any mistakes being seen, because sometimes this pen doesn't write completely clearly, and I want to make sure that you have a document that has all the numbers that are correctly seen. So you can kind of, especially, and this is kind of the big thing, especially I want you to be able to, if you're having trouble figuring out which number, which table and which number I'm looking up, I'm trying most of the places to give you the name of the table and what is the column and row, the percent and the period. And hopefully that matches up with the actual number. So if you can see the number and that matches up, then you can go and double check on the table. Okay, that's where I got that number. And then you can look at your own question, which may be slightly different numbers or whatnot, but you can get in the habit. So here we've got some question, and I don't remember exactly what the details were, but there were 3 payment options. You want to know the present value, right? So you could have $8,750 a year for 7 years. You could have $48,750 now, or you could have $99,350 in 7 years. So if you notice, this is the present value. This is an annuity, right? It's the same amount for 7 years, and this is a one-time. So we don't calculate this one because this is the present value. And then what we're going to do is we're going to figure out $8,750 this year, $8,750 next year for 7 years. We get this amount of money, but it's not $8,750. In other words, some amount of money in the future is worth less now because I can invest that money. Just like going up here, $110 next year is the same to me. Well, financially speaking. Financially speaking, it's the same to me. Now, obviously, most people would want $100 in their hand right now versus $110 next year. But if I said, take $100 today or $200 next year, well, maybe that's a big enough difference. But anyway, financially speaking, according to the interest rate, that $100 this year is the same as $110 next year. But you notice that they're different amounts. And so what we want to find out is 8,750 over 7 years, what's that similar to right now? And similarly, 99,000 in 7 years, what's that to me right now? In other words, I want to put these all on the same viewpoint. Having 3 different viewpoints, I can't tell which of these 3 is the best. So I'm going to either make them all present value or I'm going to make them all future value. You can go either way. In fact, we're going to do both. Assume a 6% interest rate. Okay, so we look it up. So this one is right here. 8,750, we look up on the present value of an annuity, 5,585.582. We multiply that, that's 48,000. Well, just slightly different, right? Just slightly different. Now we take this one, 99,000 in 7 years. Well, of course, 99,000 in 7 years, we would start off with a smaller amount of money and let the interest build. Well, in fact, you can see that the present value of that is 66,000. Now, that's a whole lot difference, right? That's almost 20,000, 18,000 difference. But are you willing to wait 7 years? Could you get more than 6%? Who knows? But the point is that 48,000 now is a lot less than 99,000 in 7 years. Not just the nominal amount, but the present value amount. 99,000 in 7 years is worth 66,000 today. So, would you be able to wait 7 years for 99,000? That's a question. I don't know. We don't have that question on the homework. Okay, so this is where we're going the other way. We're doing future value. So you could get 940,000 now. Okay, so that's a present value that we need to bring into the future value. 148,000 a year for 10 years. Okay, so this is we're going to have to figure out a future value of annuity. And then 1,850,000. Well, this is the future value. We don't need to calculate this. So this one's going to be here, and this one's going to be here. So we go ahead and figure it out. 8% interest rate, a period of 10 years. The factor is 2.159, and it figures out to be over 2 million. And then when we look at the 148,000 a year for 10 years, that's even more. So actually, in this case, we shouldn't wait for the 1.85 million in 10 years. That's much less than both of these other options. In fact, getting the 148,000 a year is the best option by a good measure. So that's how you have to look at these different numbers. It's hard to look at them when they're not comparing apples to apples. If you've ever seen sort of on late night TV, J.G. Wentworth, were you in a car accident? Do you have a structured settlement? You remember that? Have you seen these commercials? Do you have a structured settlement? Is it your money and do you want it now? Call our operators. We'll discuss it with you. All they're doing is figuring out a present value of annuity, right? They're looking up here and saying, okay, you're getting this much for over X amount of years, and then they're going to figure out some sort of present value of annuity. So maybe they figure it out, and they say, okay, let's see, where's the present value of annuity? Oh, that's right, 8,750. If you're like, I was in a accident and I'm being paid 8,750 for 7 years. And the guy on the TV makes you call him, and he goes through and he figures out the interest rates. He figures it out all correctly, and he says, yes, we will offer you 30,000. We'll offer you 30,000. And you may go, oh, 30,000 right now, or 8,750 for 7 years. I might take that. Of course, they're making out like a bandit, right? Because the present value of that annuity is 48,000. So either they'll turn around and keep it and just collect it, or maybe they'll turn around and sell it on to another financial institution. So I'm not saying that's what they do, but you can see that if someone doesn't understand present value of annuity and they call up with their structured settlement, they don't have they can find out for themselves what it's worth and not just go to one of these TV ads. Okay, coming back here. So that was how to figure out the present value and future value. Just a couple of kind of quick how to use the tables. Now, I didn't actually flash up the tables. I just kind of took little excerpts, but you're going to have to be able to look through the table and figure things out. So just coming back here, I kind of put it up before. We're going to be going over this part here. Okay. Now, like I said, I left most of these numbers in here so that rather than writing them out, that they can be, there's a lot of numbers, and so I just wanted to make sure you had a good record of how to work through it. So question 12, this is a very simple net present value. And what do we mean by net present value? Well, we've got a couple of different present value amounts. And when we say netting, we mean we add them together. And typically there's a negative and a positive. And almost always, this is, like I say, a very simple net present value. Investment we're going to spend $625,000 right now, and we're going to get a net cash flow of $90,000 for 9 years. Okay, so it's $90,000 each year for next 9 years. So that's an annuity. And we're trying to figure out, well, in the name is net present value. So we're going to get this cash flow coming in, and we're going to spend $625,000 at the beginning. So we're going to spend $625,000, and it may sound like $90,000 for 9 years sounds pretty good. But remember, the present value of $90,000 over each year for 9 years is not the same as 9 times 90. It's not 810,000. It is some smaller number, because 90,000 in 9 years actually is a present value of a much smaller number, because we have to take into the effect of the interest we would have gotten if we had that money right now. And when we go through it, so we take the positive cash flow coming in, so we take the present value of annuity, the I of the interest of 8% and the periods of 9. We look up on the table and we get 6.247, multiply by the cash flow, and we get this amount. The investment is a cash outflow. It's a negative. So we're going to net these two. And what we come up to is a negative number. Well, this is the kind of the very basic net present value is we're going to figure out a positive cash flow over time. We're going to figure out an upfront negative investment that we are spending. At the end of the project, are we going to be are we going to be positive or negative? Here, we're negative. Now, it may not have seemed that way at the beginning, but that's why we do the calculation. We do the calculation to include present value and the time value of money, so that we can know what we're getting into. Because $625,000 is a lot to spend to find out 9 years from now that we lost money. Okay, here is another one. Investment of $625,000, annual net cash flow $90,000 for next year's hurdle rate of 8%. So sometimes they use the word discount rate or hurdle rate. What they're meaning, this is the rate that you need to use on the table. So this is the same as the last question, right? Except this question was asking what's the net present value. So we're going to spend most of our time on net present value, but I'm going to introduce the idea of internal rate of return. It's kind of an odd concept, and to be honest, sometimes I wonder why we still go through with it. It is used some by financial professionals, but it's an iterative number. In other words, it's hard to calculate. What you do is you kind of keep pushing at it. You kind of figure out a kind of a high and a lower band for what this internal rate of return is. And here's an example of it. So this I'm pulling from above. We calculated this. The present value of annuity came from this. We want 8% over 9 years. And we said that should be 562. But as we saw, that gave us a negative number. So what we do is we kind of back figure. So we say, okay, it's not 562. What if it was 625, right? We wanted to get, what would we need to get? What would the present value factor? What would this number have to be to not get 562, but to get the whole investment back? In other words, what is the factor necessary to get 625? We got our factor ends up being this number, and it gives us 562. What is the number do we need to get 625? So we kind of back figure it and say, well, this would be the factor that we would need to get. Well, where does that fall on the table? Well, we can't get away from 9. This is 9 years. But what it is what we're saying is maybe 8% is too high a rate. It's too high a hurdle rate. So where along, and I've put here, so you can see here's the 6.247 that we actually, generated. But if we wanted to get a 625, and that is a number of 6.94, well, what we find out is we look along the period 9 row, and we look at the different percentages, and we see that it falls in between. So 6.9 falls in between 7.1 and 6.8. So we could figure out further and further, but what we're saying is we're not getting 8%. We're getting somewhere between this amount of money to break even would be somewhere between 5 and 6%. So the internal rate of return is not 8%, which is what we want. It's somewhere between 5 and 6%. And that is as precise as we're going to be with this. All we're trying to do is figure out where does it actually fall. If the number ends up being negative or positive, whatever, what we're trying to find out is where does it actually fall. And so here we can see that it fell somewhere in between that. And believe it or not, that's the answer to the question. The IRR is somewhere between 5 and 6%. And that is as much as we can figure at this point in time. Okay, so let's see. We're going to have a couple of these, and this is kind of more of a more involved net present value. So once again, we're looking at net present value. Now, instead of it being, the previous question had 90,000 over 9 years. So that was an annuity, right? When we have the same amount of money each year, every year, then we can use the annuity tables, whether it's present value or future value. Here, you notice that we've got different numbers. So unfortunately, we're going to have to do a present value for each of these individually, and that's what we've done here. So we're still using the interest rate or the discount rate of 14%. And what we're going to do is go on the table and look up 1 at 14%, come up with 0.877, multiply that by the first year. 2 at 14%, find that number, multiply it by the second year's cash inflow, 21,000. And same with this. So these three add up to 46,652. Now, sometimes the program accepts it, sometimes it doesn't. Just be aware that because this actually says less, the program doesn't need the parentheses. Most of the time it doesn't need parentheses. Sometimes it's not consistent, but because it's the word less, it is in it's figuring that this is a number that it will subtract from the other number. So less the initial investment, that was 45,500, and we have a net present value of, well, you would say, oh, we're barely breaking even. That's not quite the right way to interpret this. We're making 14%. We're making 14%. We're making 1,152 over the 14%. So we're actually doing quite well. In other words, we're beating the 14% rate by this amount of money. So in this case, this would we would be interested in doing. So let's take another net present value, and we're going to add on one additional factor. So I'm not going to go too deep into this top part. I'll just remark here in the question they gave you the numbers individually. They gave you here's 3 years, here's the 3 numbers. In this next one, because there were 6 years, they actually give you a schedule on the homework question. They say, okay, push this button, here comes a schedule. And it's 6 years. And once again, you find out that 6 years are all different numbers. And so you've got to go through and figure out all these different factors. So in other words, you have to create a table or write it out. And, well, not much fun. You can't do present value of annuity because each of these numbers are different. And you can't add them up and divide by 6 to come up with an average number, because that doesn't work either. So you do exactly what we did. So the last time we had 3 numbers that we had to individually calculate. This time we've got 6 numbers. We come up with a total of this amount less the initial investment. Okay, notice that our net present value is 18,847. It's not that this wasn't throwing off cash. It's that it wasn't throwing off cash to beat a 14% return. It was under a 14% return by 18,847. Well, a lot of times in these net present value, there's going to be some sort of, perhaps we can sell the piece of equipment at the end of the time. Well, that's another thing we need to calculate. Or sometimes we need to repair the equipment. Or sometimes there's an additional something or other that comes in the middle. We just have to remember that whatever this extra piece of information, sometimes we figure it out in the course of figuring out everything else. Well, this particular one says, what if after the normal 6 years, we refurbish this piece of equipment for $105,000? The equipment is going to be, we can sell it afterwards for $55,000, and it's going to generate 1 year of cash flow for $72,000. Well, because this is all year 7 stuff, we're going to leave year 1 through 6 alone and just figure out the present value, net present value for year 7, and then compare the two. So refurbishing the equipment, this is a cash outflow. This is outflow. Residual, well, that means something that money we're going to have as an inflow, and the cash we get from the income that we get from this is also an inflow. So notice we're going to have 1 outflow, a negative, and 2 inflows, and that's what we have here. So we're still going to use the present value factor of, what was it, 14%? But we're going to use N7. So the refurbishment is going to be 456. Oh, I think this is because the refurbishment is at the end of year 6. So this is probably N equals 6, because I can see that the number is the same here. So in preparation, because normally these things are at the end of the year. So this is at the end of year 6 for the beginning of year 7. So we refurbish it, at least that's how we're figuring it. So the present value factor is going to be 105,000 going out. What's the present value? Minus 47,000. We figure out the cash for that year, we get 72,000, and then we're going to sell it. That's the residual. The residual means what we're going to get when we sell it at the end of its life. And we find out that this net present value for just year 7 is positive. However, this is a present value, and this is a present value. So we can net these, and it still comes out to be negative. In other words, refurbishing it and running it for an extra year and then selling it at the end of the year is still not enough to offset the amount of loss that we had in the first 6 years. Yes, it is positive in that year 7, but that doesn't offset the negatives in years 1 through 6. So overall, even if we said, oh, we could still refurbish it and run it 1 more year, nope, it's still a losing operation. Okay, last but not least is a very easy thing, and it almost feels like it should be in the prior section just because it's so easy. But it deals with the present value of the net cash flows. And because it deals with present values, it's included in the discounting method. So this is a kind of a very straightforward kind of look at things. We call it a profitability index. If we look at 3 or more different situations and we have calculated out the present value or the net present value, we can take and we figure it out almost exactly as it's set up. If you notice here, we've got equipment A, B, and C, and I've used the same numbers, 1.710 over 1.425. The profitability index is 1.2, and we figure all we do is divide this number by the absolute value of the investment, right? So 1.95 divided by 1.875, 2.1 divided by 1.744. And we find out that if we had our choice, if we had enough money to invest in all 3 of these, we'd go ahead and invest all 3 of these. But if we only had $3 million or whatever, let's see, investment. If we only had $2 million, which of these would we invest in? Well, we would choose the one with the highest profitability index. If we had, say, $4 million and we could only choose 2, which 2? Well, we would choose C and then A, that sort of thing. And what is the profitability index? It's saying for every dollar of investment, for every $1 of investment, how much cash inflow, how much present value of cash inflow are we generating? Well, it's basically saying here, for every dollar of investment, we're generating 1.25. It is more profitable to invest in this than it is to use the money, to use that cash anywhere else. And that's all profitability index. It's a ranking system. And I've written here, this is, if you remember, we had a situation where we did something very similar before, where we had a bottleneck or scarce resource that we couldn't do everything we wanted to do. So we ranked the ones that were, in previous case, we ranked the ones that had the highest contribution margin. If you remember, we did a couple of problems with ranking contribution margin. And here, all we're doing is ranking it by the present value of the cash inflow over the investment. So still, it's still the same idea. We have a scarce resource. We only have X amount of investment dollars. Which one should we do? Well, once again, it's hard to compare them just by looking at them because they're different investment amounts and they're different cash inflows. So we find out a simple way to figure out per $1 of investment, what is the amount of cash that we get for it. Okay, well, as I said, that this was going to be a little bit longer, but that should cover almost all of the questions. The last two questions are kind of compare and contrast of the previous ones, so we've already kind of covered each individual one, and I'll leave you to do the compare and contrast methods. As always, if you have any questions, send me an email or catch me up on Zoom, and have a good day.